Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast. We're back once again to continue to share tips and strategies that are going to help you to feel much more comfortable and confident so that you can feel comfortable, confident, and having more control investing beyond your backyard. I'm your host, Billy Keels. And if you've ever wanted to know the super secret weapon as it relates to being successful in real estate investing, then you know what? You're definitely going to want to stay tuned for the entire conversation today. And you know why? Because today's guest not only has 2 decades of experience as a teacher, he's also a father of 6. Yes, I did say 6 wonderful children. And he has found a niche that helps people to legally be able to lower their tax bill. That's the super secret weapon. Today's guest is also the head of business development of Madison Specs, and it gives me great pleasure to welcome to the show, Yonah Weiss. Yonah, welcome to the show.
Thank you, Billy. It's a pleasure to join you. Thanks so much.
Yeah, I'm really looking forward to today's conversation. And for those of you that are watching us, you can tell where Yonah is today. Yeah, well, and if not, there we go. Wow, that's a wonderful place. That's called Barcelona. That's where I live. So thanks for that, Yonah. I feel right at home. And speaking of which, Yonah, we always love to be able to help people understand where our guests are located. And I'm super excited for you to tell us about where you are located today. What city are you in today, Yonah?
I'm in the beautiful city of Jerusalem, Israel. Awesome. So it's a little city. Many people have heard of it before. It's probably one of the most famous cities in history. I've actually lived here for close to 20 years, originally from the United States, but moved here about close to 20 years ago and been working remotely for the past 5 years for a company based in the United States. So
awesome.
There you go.
Awesome. So love that. Based in Jerusalem. So this is long distance. We love that. And the second thing, Yonah, what is the most positive thing that's happened to you in the last 24 hours?
I love Sundays because in America, in the United States, which my job is based in, is not, there's no work pretty much. Mm-hmm. I mean, still, some people still, put in a little time work here and there, but it means I get to spend a lot more time with my kids. So that's really what I love to do. So I was able to make supper for them, which is something I love to cook, spend a little time with them doing that. And just got to play with my kids, read a little bit with them. And was definitely the most positive thing that happened to me.
I love that. And Yonah, you know what? Many times it's the super simple things in life that can give us the greatest pleasure. It's just a matter of being able to take time to appreciate it. So thank you for sharing that. And for everyone, when you get the chance to spend quality time with your kids, this is just another reminder that it can be one of the most special things that there is on earth. So thanks, Yonah.
Absolutely.
So listen, so Yonah and I are going to talk about something today. And I talked about this super secret weapon that's going to be able to help people in terms of being able to legally lower their tax bill and do that in a way that is probably a way that they've not heard before. But before we even get started with today's conversation, it's really important to let everyone know that Yonah and I are going to be speaking about ideas, concepts that he is using and that he's seen and has an experience with. Just to get started, anything that we're talking about, you're going to want to speak to your tax professional from the very beginning because your situation is very unique and very different. And we just want to make sure that it's crystal clear to everybody before. But definitely, you're going to want to stick around for this entire thing because it's awesome. Yeah. So I had to get that out of the way. And I know we talk a lot about the different ways that real estate can provide returns. A lot of times we talk about cash flow, we talk about appreciation, we can talk about amortization and residents being able to pay down or build up equity over time. And then there's this other area, which is depreciation. And so we're going to talk about that. But before we even get into that, Yonah, could you do us a favor? Just give us a little bit of your backstory as well, please.
Sure. And like you said, you introduced, I spent 20 years as a teacher, really from when I was in high school. I was doing kind of private tutoring for kids in elementary school and, junior high school. And I just loved teaching, and I got a job, really my first job as a teacher, even when I was still in high school. So it was something that kind of just was my passion. And even to today, I'm still really passionate about. And it's more about not necessarily formal teaching, in a classroom per se, but it's about when you have that, thirst for knowledge, you want to share that with other people. And if you know something, then you can teach that. And that's kind of been my philosophy. I may not be the smartest person. I may not know everything about a certain subject, but if I understand something, I want to share that with other people, especially if they don't know it yet. So that's kind of, was led up to, a certain point in my life until, like I said, about 5 years ago or so, I was looking for some additional income, so some more to, kind of teacher salary is definitely not the greatest. And I found real estate, and I had a lot of friends that were in real estate. And so I was able to kind of very easily get my foot in the door and just to educate myself, which happened pretty quickly. And I would say that I started off as a commercial mortgage broker, just kind of really learning the ropes of commercial real estate, of the financing side of things. And then I wanted to learn the residential kind of brokering, just learning how to, buy and sell, the sales side of things. And I kind of got my feet wet with a lot of different aspects of real estate and just kind of fell in love with everything that had to do with real estate, and especially the networking, aspect of the people. I kept meeting people that were really forward thinking, growth oriented people, who many of which came from corporate jobs, similar to myself, who had been working for, 10, 15, 20 years, and found that they weren't necessarily satisfied with how they were tied down so much to their jobs, and wanted to find, a different way to kind of create income, create wealth, create generational wealth. And that's kind of how my approach has been in real estate. And I've been blessed really to work for the last few years with this company, Madison Commercial Real Estate, Madison Specs, that we do this thing called cost segregation, which is the most incredible tax savings tool that literally I get to spend all day long, one, teaching people about this incredible tool, and two, helping people save money. So people love me, and it's great to be in a job where on the one hand, I also invest in real estate, so I'm able to use that, what I'm preaching, what I'm teaching, or what have you. But at the same time, I'm able to help people and get that kind of be in a job that I love.
Wow. Being in a job that you love, and when everyone sees you, they get that smile, right? You have this radiant smile as well. So that I'm sure that's a lot of it, but you're also helping people to, use that special tool that we talked about to generate new opportunities for themselves and for those that are around them. And so, I know you mentioned as well that you learn the ABCs and you teach the ABCs, right? I know that's one of the things that you talked about just now. I know it's one of the things that people know you for as well. So I'd love to be able to start out the conversation there, really, is just understanding some of the basic foundations. So you talked about cost segregation, but could you help us just before we even get into the conversation? There are three concepts that I think are really important to build the foundation. One is, what is depreciation? The second is, what is cost segregation? And the third is, what is recapture?
Excellent question. So yeah, let's build on the foundations. Depreciation, as you mentioned, one of the most important aspects of real estate investing, definitely in the top 3 or 4 of those wealth building aspects, is the tax advantages. And so depreciation is a tax benefit. And this exists in other countries as well, but I'm going to really focus on the United States and the specific tax code. And once we get beyond this, after we get those 3 foundations of what's depreciation, what's cost segregation, what's depreciation, recapture tax, I want to then go into something which I've really not spoken about much before on many podcasts, which is the specific relation to these laws to a foreign investor. Okay, so someone
Love it.
who's investing from outside the United States, how will this impact them? Because it really has not come up and been so relevant, and many of the times I've spoken about this, but is something that I think with your podcast today, Billy, we kind of touch on that.
Love it. Love it.
So depreciation, it sounds like a negative thing, right? When something goes down in value, but in truth, it's a tax deduction that the IRS gives you when you buy a commercial property. So you buy any property besides your personal residence, you get to now write off as an income tax write-off the entire building, okay, the entire value of that building. So you buy a building for $1 million, you now get to subtract a certain amount for land. Land doesn't depreciate, but the remainder is now an income tax write-off. That means you deduct that from your income tax. However, it's not as simple just right away. You actually have to spread that over a long period of time, okay? So for commercial properties, it's 39 years. And for residential properties, including multifamily, because multifamily is considered residential, people live there, is 27 and a half years. So what we do is we take this entire amount of $1 million, subtract a little bit for land, and then that you get to take as an income tax deduction a little bit every single year for 27 or 39 years. So it winds up being somewhere between 2 and 3% of the actual building value at the time of purchase every single year as a tax deduction. So this is deducted from your income tax. You make $50,000, you have a depreciation of $20,000, you deduct that, you only pay taxes on the remaining 30. That's in a nutshell what depreciation is. And I want to stress here from an income tax standpoint, it's kind of a borrowed term because, like I mentioned, it means something's going down in value, but it's a borrowed term in the sense that it's the schedule. Those 27 or 39 respective years start over when you purchase the building. So it's not intrinsic to the property, which is something really you have to understand, because depreciation, people are like, yeah, it makes sense. Things go down in value as time goes on. You get a tax write-off based on that because there's, it's less value to it. But it's not true, because if you bought a building that was built in 1970, okay, it's fully been quote unquote depreciated, but you now buy it in 2020, you get to now start that 27-year schedule over from day one when you buy it. So, and based on the purchase price that you bought it. So it's not intrinsic to the building. Again, this is just a tax benefit the IRS gives that, a tax write-off for this. So that's depreciation in a nutshell. Is that good, Billy? That's
fantastic, and especially the last part, right, is that it's really specific to the individual and the specific asset at purchase. So that's fantastic. So thank you for clarifying, helping us understand exactly what depreciation is and also the benefits of it. So I guess that would put us.
Yeah, it's huge because, when you think about it, you now, just because you bought a building, you now get these tax write-offs. Okay. There's, virtually no other asset class, that's like that. There are certain businesses, if you have a business and you buy certain equipment, you can take as a tax write-off, the things like that. But when you actually buy a building, purchase that's incredible. So that's depreciation, but cost segregation is really just an advanced form of that. So there are, just like we said, there's quote unquote a useful life to a building that was assigned a 39 or 27-year period. There's also a useful life to other things within the property. So it used to be called component depreciation, which makes a lot more sense, which essentially means like this: the property that you bought is not just based on there's not just two categories, and there's not just two things. There's not just the building and the land, right? Land doesn't depreciate, building does. There's actually a lot of other things in there that depreciate on different schedules. So there's number one, there's stuff called personal property in a building, which can include anything like equipment, furniture, appliances. And when you think of an apartment building, you have bookshelves, you have cabinets, you have all kinds of furniture and fixtures and all kinds of stuff. So
all that stuff.
Exactly. Carpeting, anything that's not really part of the integral to the structure. So, what's integral to the structure? What's the building? Really floor, ceiling, roof, walls, windows, doors, main electrical, main plumbing, and that's pretty much it. Okay. Everything beyond that can actually be identified from an engineering standpoint. And that's why cost segregation requires an engineer to actually come into the building, identify what all these things are, break them out into, and say, no, all of these assets now depreciate on a 5-year schedule. Okay. We take them, find out how much each little thing is worth. We say all the carpeting is worth, 20,000 square feet of carpeting is now worth $20,000, whatever it is. And the furniture, the fixtures, add that all up. Now take that as a tax write-off over a 5-year period instead of lumping it all together and getting 2 to 3% a year based on your purchase price is, it's great. But if you can take 20% and put that in the first 5 years or even in the first year as a tax write-off, that's huge. It's huge for, your cash flow. It's huge for your overall wealth building.
Amazing. So that anytime we can talk 10x or more, then that's a pretty positive thing, especially when we're talking about increasing the cash flow. So I think that has been very helpful. And I know we're going to come back to the cost segregation. And then just the last point that we wanted to talk about, and just help people understand when we talk about recapture tax and what that is as well.
Absolutely. So, this is all fine and dandy, right? The IRS allows you to take these tax benefits. It's really more than anything the time value of money. Getting these tax deductions now, taking advantage of what you can now so you can build that wealth. But when you sell a property, whenever you go to sell a property, okay, whether that be in a year, 5 years, 10 years, 30 years down the road, you have 2 taxes that you have to deal with. Okay, number one is called capital gains tax. So if you actually made any money, made any profit on the sale of this property, bought it for $1 million, sold it for $2 million, you now have to pay a tax on the difference. Okay, that difference is called capital gains tax. There's a second tax, which is called depreciation recapture tax. So you have to take the amount of depreciation that you actually took as an income tax write-off during those years of ownership, and now you pay a tax on that amount. Okay, and the main category of that is a 25% tax on the main category of that. There are certain aspects of that, like the personal property that we may identify through cost segregation, that you may potentially have to pay a higher tax rate on the recapture of that. And so you have to put this into your business plan and understand that it's not just about taking advantage now, it's also what do I do if and when I sell the building, what am I going to have to face in terms of taxes at that point as well.
Fantastic. So this is part of, once again, the financial modeling, understanding the impacts of using the different depreciation schedules. And it's something to also take into consideration as you invest in either directly or indirectly through new types of assets. So that is fantastic. Actually, and I know you like bonuses and kind of adding a little stuff, but there's this thing called bonus depreciation as well. Could you help, especially those of us that are outside the United States, understand what is bonus depreciation and why is it so cool?
Absolutely. So a couple of years ago, when there was a major tax reform, 2017, 2018, Tax Cuts and Jobs, a huge tax reform in the United States that introduced a new law that was called 100% bonus depreciation. And what that says is that any property or any asset that depreciates on a faster rate than 20 years. So that's like when we do a cost segregation study, like I mentioned before, what we're doing is we are identifying all those things in a property that depreciate faster than the main structure, 39 or 27 years. So that includes, like I said, the personal property, oftentimes, 20% or more. Mm-hmm. Then there's land improvements, which actually is not the land itself, but the land improvements, landscaping, pavement, concrete, anything outside the building. That depreciates on a 15-year schedule. So anything that's less than 20 years is everything we identify with a cost segregation study. Once you get that cost segregation study done and identify what all those things are, you now have the option to take the entire amount of that in year number 1. So I kind of hinted to that before. You can front load it all to the first year. And so if we're taking $1 million building, you get a 20% tax write-off in the first year because you're doing this 100% bonus depreciation. That means you're taking a $200,000 tax write-off in the first year. It's huge. It's really a game changer for a lot of people. A couple of things to note about the bonus depreciation without getting too much into the details. It's temporary, this law, so it's going to start phasing out in 2023. Okay, so you're going to want to make sure to take advantage of it now so that you can get the maximum benefit from it, because in 2023, it's going down to 80% bonus depreciation. So you can take 80% of that accelerated amount in the first year. Then it's going to continue going down until it phases out to 0.
And at 80%, that's where it was before, right? Before this new.
No, it actually was.
Or
It
50.
really didn't exist before to the extent that it does now. It existed in the form of new development. So if you did a new development, you could have taken 50% of those accelerated portions in the first year. And that was only for new development. However, the law, why it's so great now, is it applies to every single acquisition. So you buy a building that was placed in service that's been around for 50 years, doesn't matter. Again, your depreciation schedule starts now. When you buy it, so does the bonus depreciation.
Awesome. Okay. And once again, so Yonah's talking to you about it. So you want to make sure that you're talking to your tax professional, find out how in being part of projects where bonus depreciation is a major part, how that can potentially help you. So, Yonah, and we're going to come back to that thing for anyone who's outside of the U.S. or for people in Europe specifically, but just to make sure, right? Because I know that a lot of times people are wanting to understand more about cost segregation, but you said something earlier, and I just want to confirm, so have you confirm it. Basically, you're, as a structural engineer, like the engineering firm will work with the CPA so that both teams working together can really help to understand not only what the specific line items would be, but also then the tax implications of that. Is that correct?
Exactly. So it's not specifically a structural engineer. It has to be an engineer that is well-versed not only in construction, structural engineering, but also in the tax code. So that's why there are companies like Madison Specs, our company, where we actually employ engineers on staff that do this. Yes, there are certain accounting firms that will have engineers on staff as well. Mm-hmm. The biggest accounting firms in the United States have engineers in-house for this very reason, because they're dealing with huge corporations and huge companies that have that need. Most accountants cannot do this on their own. So yes, we work together with your accountant to make sure that you can maximize this and take advantage of this tax benefit.
Okay, perfect. And also, just to be very clear, this is, in terms of cost segregation, this is something that can only be done by specific individuals. Just like you shouldn't be doing your own taxes, but this is an area where you literally cannot do this cost segregation.
Right. Even accountants can't do it on their own, because even though it's an accounting methodology, it requires, according to the tax code, the cost segregation audit techniques guide, clearly states that it should be performed by someone with the engineering experience. Okay,
perfect. Appreciate that. Yonah, because cost segregation, some people have never heard of it. You're helping to educate us now. And I'm just curious, when would you say is the right moment for someone to even consider cost segregation as part of their investment strategy?
It's usually the best time, it's going to be different for different people, but usually the best time is in the first year of ownership. Especially if you have a tax liability, right? If you are paying taxes, you want to make sure, hey, here's a great strategy. I can lower my taxes. If you're not paying taxes, let's say you just bought a building and it's vacant and you have no income, then it may not make sense at that point, because you're just creating deductions that are not going to, these type of deductions of depreciation do not create a tax refund. There are certain other types of deductions that might. This does not create a tax refund. It will create a passive loss, which means you will just have a negative balance. It's not a negative thing. It just means you can't use those extra deductions this year. You have to carry them forward. You can use them in future years. So it may not make sense to get it done if you're not making money. Only if you're making money and you need to use it.
Okay, perfect. And then appreciate that. Yonah talked about something, passive losses. We can probably have you for the 202 course on that, where we can come back and help people understand the difference between the passive and active and ways that you can do that, different real estate professionals, et cetera, et cetera. But that's going to be for the 202 course. Today, we're just helping get everyone started. Also then, so in the first year, but then Yonah, would this make a lot of sense for someone that has a $100,000 house, or is this something that's more like a 500,000, $1 million? Kind of what types of properties would typically someone say, okay, it's the first year and it's this type of property where it makes sense to do a cost segregation study?
Excellent question. It's usually relegated for larger properties. So, anything over $500,000 really makes sense to check it out. And part of the thing that we do as a service, a free service, is we'll do a free estimate. We'll do an analysis on any property so you can kind of see what those numbers would look like. What will your tax benefits look like if you did a full study? And the reason why I say this is because it's percentage, okay? So it's proportional to your purchase price. Remember, the depreciation is totally based on your purchase price. If you have a low purchase price, you're going to have a low percentage of reallocation that you're going to take as a first-year tax deduction or first 5-year tax deduction. It only really starts making sense the bigger the property gets because, again, number one, there's a fee involved in the service. It's not a free service, obviously, but, depending on how much you need may determine how, what size property is going to benefit you. But like I said, over $500,000 purchase price usually makes sense to check it out.
Okay. So over $500,000 makes sense to check it out. And I'm sure everybody's situation is a little bit different, but what I've heard you say also too, is that the cost segregation studies that you perform are done as an analysis. So really someone can actually see, is it going to be, I pay X and I get a 4X or 5X or 6X return. If you see that and it makes sense, then why would, then it makes sense. Pay X to get 7X back, right?
Right. Exactly. So that's part of the reason why we do it. Like I said, I don't push it on smaller properties, but everyone's, welcome to make their own decisions.
Awesome. And is this, so as everyone makes their own decisions, we're able to see also too, that you mentioned you're in Jerusalem, right? One of the things I understand about cost segregation, or that would like for you to help us also understand, is you talked about different members of the team. Is this something that actually has to be done physically? Is this something that can just be done on spreadsheets? Kind of how does that work?
Yeah, excellent question. So like I said, I've been working virtually, right? Working remotely, if you will, for the biggest national company, Madison Specs, that does cost segregation. So we have a whole team of engineers, accountants, a whole operations team based in the States. And we work in all 50 states. So we actually work across the nation. However, up until this whole pandemic, COVID, hit, we were very, careful at making sure that every single property had a full engineering inspection. And so we send one of our engineers to the property, and this is part and parcel of the study getting done. Because of the situation, did not allow that, and we still have, hundreds of people knocking on our door saying, we need this done. What are we going to do? There are travel restrictions, there's all kinds of people don't want anyone entering in, even with proper, protective gear. We created, and we kind of pivoted and created a kind of virtual site tour where we have created, and we're still perfecting it, but we've created a digital kind of video engineering tour where we'll have, with the help of someone on site. So if that's a property manager, if it is one of the residents, if it's one of, you have a building maintenance person who can actually take a video tour with the engineer on the other line, showing them around every square foot of the property, keep that footage and then, use that to create the report. Essentially, it's the same thing that can be done. And now we can do it remotely. So I think this is something that we've done to pivot, if you will, or kind of adapt to the current situation. And I think it's going to be good for everyone.
So I think that is fantastic. It's going to provide value for everyone. Also, too, once again, it comes back to the power of teams, right? You can be remote, you have technology, and you have teams in all 50 states back in the US. And so once again, it's having strong teams, leveraging technology to ultimately be able to provide value and benefit for the client.
Exactly.
So, I do want to come back to something that you alluded to in the very beginning, right? For those outside of the United States, this is something that you were going to talk about for the first time here. And so feel free to go ahead and share with us what you wanted to share.
Oh, so yeah, just in terms of investing, real estate investors investing in the United States, depending on which country you live in, there may be, double taxation. Okay, so there's really two things you have to understand here. Number one is who you're investing with, okay? When you invest in the United States, you're putting money in the United States and you are creating income in the United States. you are going to be liable for taxes in the United States. Now, that amount of income is eligible for these tax deductions, these tax benefits. So you will likely, even if you are not a United States citizen, you will still get those tax benefits from the income being produced in the United States from that perspective. However, and this is the big however, the second thing is you have to understand what your tax situation is back in the country where you live, because you may be subject to a double taxation, depending on the treaty, that the United States has with that country. There are ways to get around even any possible double taxation. It might cost a little bit more just to create an extra entity in the United States, which might be called a blocker entity, which might be able to feed basically the entity or the legal structure who owns the property. And this is how most people buy real estate in the United States, is through an entity, through an LLC or through a corporation. Usually it's through an LLC. And that entity owns the property, and everyone who invests in that has shares of that, and now receives those distributions through that entity. Another entity can be created that the shares basically distribute to that second entity, which is called a blocker entity. Okay. And again, speak with your lawyer, speak with your accountant to make sure you get this right. But it can be done in such a way that that money is protected from being taxed by your foreign country, or not your local country in this regard. So that's important to know. So again, there's ways to invest in the United States and to take advantage of these tax benefits if you're doing it with the right team that is taking advantage of the cost segregation.
Fantastic. So that is, and I just want to once again reiterate what Yonah just mentioned. I mean, the important part is that you really sit down with your both tax as well as legal professionals to figure out what are the structures that you are able to do in what I like to call in the legal way that you can sleep well at night, right? And so This is the most important thing. Neither Yonah or I understand your specific situation, so definitely reach out to your specific person that understands your situation and the country in which you live, because that is the most important thing. And a lot of times, and this is one of the things that we're working with the Going Along community, Yonah, is really being able to ask the right questions so that you can get the answers to figure out if it makes sense for you, your specific situation, your context, to move forward or to not move forward. So
yes,
thank you very much for sharing that, Yonah. And we heard it here first.
Exclusive coverage.
Exclusive. Yeah, man. Here we go. So listen, a couple things, Yonah. I want to continue to talk with you. There's so many more things that we could go into. Unfortunately, time is limited, right? And so we started the 101 course today. Love to be able to have you back in the future and go into some more detail on some of the different areas. But one of the things that I always like to do, because this is what our Going Along listeners and audience love, is to be able to ask the Going Along final 3 questions. But the thing is, Yonah, I never ask the Going Along final 3 questions until you tell me that you're ready for me to ask you the questions. So my question for you is, are you ready?
So it's really 4 questions.
Love it. You got me.
Yeah. I'm ready. Let's do it.
I figured you would be. Awesome. So one of the things I'd love to be able to continue to connect Europe with the US. And I always want to know from each one of our guests, what is your favorite European city that you've either visited or you still plan on visiting is on your bucket list?
Believe it or not, I've been to quite a few European cities. I don't really even have a favorite one, but I will say, for the sake of this podcast, Vienna, because that was a nice little trip. I was just there for a couple of days.
Beautiful.
A few years back, and I didn't get a chance to tour around that much, but the little bit that I had there was nice.
Okay, awesome. So there's a vote for Vienna. Perfect. Thanks, Yonah. Appreciate that. And also, too, next question. All right, we talked about you being a teacher for 20 years. You are connecting with people all over the globe. I mean, that on the 202 session, we'll talk about what you're doing on social media and LinkedIn specifically. But I'm going to guess probably once or twice, because you're a successful person, that you've probably made one mistake, only one, I'm sure. But if you had to share one lesson, right, that you could pay forward, what would the one lesson be that you would pay forward to someone who is interested in understanding more or getting more involved in real estate investing?
Yeah, and I made lots and lots and lots of mistakes. So
that makes two of us.
Yeah, and everyone has to make mistakes, but it's about recognizing those mistakes and learning from them. I think the biggest mistake that I could share with with your listeners at this point that you might be able to relate to is I started out, like I mentioned, as a commercial mortgage broker. That's kind of my first taste of real estate, of commercial real estate. And doing that, it was a lot of cold calling, a lot of cold outreach. And what I learned from cold calling and cold outreach is that it's really a numbers game. If you approach it as just cold calling and cold outreach, it's literally just a numbers game. You can get lucky. You can call it, whatever God's shining on you that day or not, or whatever you want to call it. It doesn't matter. And I hated that. I literally couldn't stand it because I love people and I love connecting with people. And, when you really realize you have a true value to bring to someone else, it's not just then it's so hard to do a cold call because you feel like you're selling yourself short. You're selling the recipient of that call short because you have so much to offer them and they don't even take the time because you're approaching it in that way. And I learned, not as quickly as I would have liked, that there are much better approaches to create warm calls and warm outreach. And maybe this is a good segue into social media and how that helped in doing that. But I think so I guess the mistake that I made was to think that, if you have a boss, on top of you saying that you have to make a quota of calls every day, you have to get a quota of sales, et cetera, every day or week or month or whatever that is, that you have to conform and do it exactly that way. You have to find what your calling is, what speaks true to you, and find a way to work it out that makes much more sense and usually makes a lot more dollars too.
Love that. Not only makes more sense, makes more dollars, probably a lot more dollars. Awesome. So thanks for sharing that, Yonah. And then this is going to bring it home. So I always want to continue to feed the mind. So would love to know what book you would recommend to the Going Long audience.
Yeah, so many books, but one that just came to mind is a book called The Compound Effect by Darren Hardy. It really just teaches the principles of doing little things, little habits every day and kind of building on them. Little things every single day. And one example you give is like if you want to exercise, right? And you say, I want to start exercising every day. You're not going to exercise every day. It's not going to happen. You have to start by doing very little small things that will eventually lead you up to that point. So just put on your shoes, your running shoes, your tennis shoes every day. Okay. And you start putting on your tennis shoes every day, then you can now get to the next point where, hey, I'm actually going to go for a walk, right? Because now I have my shoes on already. And so that will eventually lead you to, exercise maybe once a week, and et cetera. And this applies to business. It applies to habits. It applies to life. It applies to everything.
Fantastic. Okay. The Compound Effect, Darren Hardy. So thank you so much for that. One of the things that I realized just now, I don't think I would like for you, because I want to do a quick wrap up, but you have a pretty awesome podcast that you just launched. And I know that I wanted to mention that in the beginning and I forgot to do that. So can you just tell us about the podcast specifically? And then I'll give you a chance to tell us other ways to get in touch with you, but please tell us a little bit about the podcast and kind of what the motivation was for you there.
Absolutely. It's called Weiss Advice. So my last name, Weiss, it's a play on words. Weiss is wise, right? But it means, the idea to me was, I was a guest on I've been a guest at this point, at the point of this airing, over 100 podcasts. And most of them are in the real estate world. And I saw that a lot of them were exactly the same. In the sense that they're bringing on guests and they're great educational content and learning something, but there wasn't much more else to offer. And, that was fine. That's great. But what that does is that it limits your audience, because you can only have so many podcasts out there that can do the exact same thing, right? And everyone should find those podcasts. They're tremendous. Each one of them in their own right are tremendous, but you can't listen to all of them. So I figured I want to do something a lot different than that. And besides for the fact that I love this platform, I love podcasts, I love interviewing, I love, talking to people. And I like to keep it a lot more unscripted, just more conversational. So I like to think of it more like a talk show than a podcast, because I interview people who I believe, people that I know and people that I believe are successful. And I want to learn from them some tips and some advice on, how they got to that success, some of the challenges, failures, things they're doing, current events, that kind of stuff. So I'm interviewing maybe some of the same people that might be on the podcast circuit, but I guarantee the interview is going to be totally different.
Love that. Wise advice. And we're going to come back to that again. So thank you for sharing that and being able to do things differently, drawing on your previous experience of over 100 podcast episodes. And yeah, you're continuing to make an impact. So, and speaking of which, just today, Yonah, you've helped us build the foundation. You've helped us to understand this concept that is nebulous to many, and you've helped it to make it really concrete, helping us build the foundation, not just cost segregation, but also understanding more about depreciation, understanding more about what recapture tax is, diving into bonus depreciation. You've helped us to understand that, yes, you can continue to use technology, work with teams, and derive lots of value for clients, and being able to do that around an area such as cost segregation. So this is fantastic. Really appreciate you sharing all that goodness. And, because I know that I want to continue to stay in touch with you. And I'm sure that there are so many people that are trying to figure out, well, yeah, he mentioned that he's in Jerusalem and he's doing this and he's doing that, but how do I actually get in touch with him? Give us a little bit more about Weiss Advice, but how else can people get in touch with you, Yonah?
You can find me on LinkedIn. That's the best place. In fact, Billy, that's where we connected first, I think. And or you can go to YonahWeiss.com.
All right. Fantastic. And definitely check out Weiss Advice, the podcast. You can go to YonahWeiss.com, his website, and you can definitely check him out on LinkedIn. He is constantly adding value to people all around the globe, and he's been able to do this in a very short amount of time. So, but maybe we can entice him to come back and share a little bit more of the social media tips and ways that he's adding value from there. So, Yonah, thanks so much for joining us today on the Going Long podcast.
Pleasure. Thank you, Billy. It's been a pleasure.
Awesome. So, and listen, Going On audience, once again, as we're continuing to get started, we're being able to have wonderful value add guests like Yonah today. We're going to continue to ask you to help us to build this community with other like-minded individuals. So go out and share this episode with 2 or 3 other people at least, right? And in that way, you're helping us to build with the exact type of individuals, the great positive energy that we're bringing, and also be able to, like I said, attract guests like Yonah. Feel free to give us some feedback, leave your reviews. We'd love to get your written reviews on today's episode as well. That will help us to understand what we give you more of and things like that. And I am really looking forward to welcoming you back to the very next episode. And until then, go out and make it a great day. Freedom! Wow, don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.